all leads us to our talk of the tape. Is a moment of truth for the markets fast approaching? JP Morgan's closely followed technician says it could be. A level for stocks, he argues, is so important that if it breaks, could lead to accelerated declines. Jason Hunter joins us now on the phone. He's head of technical strategy at JPM. Welcome. It's good to have you on our program. I mentioned off the top here, it's the 200-day moving average that everybody seems to be fixated on. You are watching a different level, though, on the S&P. Can you tell our viewers what it is and why?
Oh, thanks for having me. Yeah, really, it's a cluster of levels in the 3900s, including the 200-day. But in the same area, you also have the 50-day, 100-day moving average. And more importantly, if you look at 3,900 in that area roughly and go back to May of last year, as the S&P is traded in this very broad range, it's traded around that either as support or resistance. So obviously today you could see the market trying to bounce from that key area. But we think the pressure, increases on the downside. And even if we bounce over the near term, we're expecting an eventual break through the downside and an acceleration to lower price levels.
How would you describe where you think momentum is in the market right now? What started the year out with some newfound momentum has obviously come to a bit of a stop recently as rates have continued to move higher. So how would you assess that?
Yeah, so I would say if you look at the lower frequency momentum signals, which, as a technician, if you just look at the charts in isolation, things like the golden cross, the 50-day average moving above the 200-day average, statistically actually have decent forecast value for a 3 to 12-month period, and that's to the upside, where it does better than random trade entry. That said, we also incorporate a macro overlay to our work because these signals don't just operate in a vacuum. And one of the things we highlighted, if you go back and look at the early 1990s, the golden cross triggered right in front of that early 1990s recession. And when we think about things like the yield curve having been inverted for a year, backward-looking S&P operating leverage declining for a year, the market now projecting Fed policy rates to more than 2x, theoretical neutral. The odds that you get a signal failure, we think those are pretty high here. We didn't follow that and that momentum signal. In fact, we were saying sell 4,100, 4,200, and look for the eventual break to the downside.
You also argue that the S&P looks overvalued by something you point to, the money market curve. I want you to explain that to me. Are you just simply talking about there are other alternatives outside of equities where you can get a better return than in the equity market, one of those being in pure cash and the interest rates that you get paid for now?
So while that theme aligns with what we're saying, what we're actually looking at in that model is the shape of the money market curve, which is to say how high is the Fed expected to raise rates over the near term, and then how many eases are priced in on the back of that. And for that, we're looking at the forward OIS market to see what the market's expecting that Fed policy rate trajectory to be. We've used that for the better part of the last year, which has done a very good job explaining the S&P, as it's been mostly multiple derating in line with Fed expectations that they're going to become more and more hawkish. If you look at the S&P over the past month, because we've had hot data both on the demand side and the inflation side, you've seen the money market curve hawkishly reprice quite a bit, and the S&P is actually not sold off nearly as much as you would have thought given that. So even with the sell-off we've had, we've gone from 2 standard deviations overbought to about 1.5 standard deviations overbought. On fair value, give or take, is about 3,800 on that model, by the way, how the Fed's priced right now.